The Bogleheads. The devout followers of Jack Bogle and his investing philosophy is one of the most well-respected DIY investing communities around. So let's dive into what their philosophies are and what we can learn from them. And hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. The number one Boglehead investment philosophy: live below your means. Investing is essential for building long-term wealth. If you're not investing your money, you're falling behind. However, if you don't have the money to invest, all this talk about investing means nothing. $0 invested ends with $0 in your portfolio. So before you get into investing, you want to first get good with savings. So how to save more? It's simple. Live below your means. But of course, easier said than done, right? And for most people, this is actually the most difficult part of the wealth building process. Why? Because ever since we were young, we were conditioned to spend. We've been bombarded with advertisements, surrounded by the consumer culture, and often rewarded for consumption rather than restraint. From our first paycheck, the message was clear. Spend to show success, spend to feel better, spend to keep up. But the truth is that wealth is not built by what we spend. It's built by what we keep. Therefore, before we get into investing, we need to fight the social expectations and develop the habit of living below our means. Building wealth has little to do with your income or investment returns, and lots to do with your savings rate. Number 2 Bogleheads investment philosophy: develop a workable plan. Once we learn to live below our means, it's time to develop a workable plan that can take us to the next step. And the Bogleheads approach to developing a workable financial plan begins with establishing a sound financial lifestyle. Let's discuss a few of its key components. 1. Develop a sensible household budget. A budget that ensures you can meet necessary expenses like housing, food, and clothing, but still allows for discretionary spending as well as saving for major life goals like buying a home or retiring comfortably. 2. Avoid bad debt, especially high-interest debt like credit cards. If you have any, make paying it off a top priority. Without freeing yourself from debt, it's nearly impossible to build a solid foundation for investing. And 3. Write a simple, workable investment plan. It doesn't need to be perfect, just reasonable. It should include things like your goals, timeline, asset allocation, and assumptions. Then revisit and revise as your circumstances or understanding evolve. Now, many of you hearing this might be thinking, I don't need a plan. I can save and invest without a written plan. However, the reason why the Bogleheads emphasize developing a workable, written plan is this: because the act of developing and writing a plan builds discipline and clarity. And only when we have discipline and clarity will it turn into action. Your plan should be simple, easy to follow, and tailored to your personal situation. In talking about a workable plan, do you ever wish there was a tool that could not only organize all your financial accounts, but also help you plan for your future? Well, what if I was to tell you there actually is? Which is why I'm excited to talk to you about today's video sponsor, Empower. If you're like a lot of people, your financial accounts are probably scattered everywhere. A 401k from your old company, a Roth IRA with a broker you haven't logged into in years, and probably a few checking and savings accounts at banks you're not sure are still around. It's overwhelming to keep track of everything, let alone plan effectively for the future. Well, this is where Empower's free personal dashboard can help. Once you connect all your financial accounts to the personal dashboard, not only are you able to see all your accounts in one place, you now have access to a powerful retirement planning capability, the Retirement Planner. The Retirement Planner automatically pulls in your current savings, investments, and contributions and creates a personalized projection of your retirement readiness based on your actual financial data. You can even account for major life expenses like putting your kids through college or buying a second home and see exactly how they affect your retirement timeline. No more guessing about where your money is, how it's performing, or if you're on track for retirement. What makes this even better? All these features are completely free when you sign up. So if you want to stop wondering about your retirement readiness and start knowing exactly where you stand, I highly recommend you check out Empower today. Please go to my special link in the description below and get started with their free personal dashboard and powerful retirement planner. Again, I'll have the link in the description below. Alright, with that said, let's get back to the video. The number 3 Boglehead investment philosophy. Alright, now getting more into investing. Never bear too much or too little risk. Now, this might sound like something out of a Goldilocks tale. Not too hot, not too cold. But when it comes to investing, it's a very important piece of wisdom. This principle underscores the importance of aligning your investment risk with your personal capacity to handle it. Taking on excessive risk can lead to panic during market downturns, potentially causing you to sell at a loss. Conversely, being too conservative might result in returns that don't keep pace with inflation, eroding your purchasing power over time. The Bogleheads emphasized that your asset allocation, the mix of stocks, bonds, and other investments, should reflect your individual risk tolerance and investment horizon. For instance, younger investors with a longer time frame might afford to take on more risk, while those nearing retirement should consider a more conservative approach to preserve capital. Ultimately, the goal is to find a balance where you can stay invested comfortably through all the market conditions. As the Bogleheads philosophy suggests, a well thought out, balanced approach to risk can lead to a more consistent and satisfactory investment outcomes. Risk is what's left over when you think you've thought of everything. The number 4 Boglehead investment philosophy. Continuing the line of investing, invest early and often. This principle underscores the importance of starting your investment journey as soon as possible and maintaining consistent contributions over time. And this is not something you just hear from the Bogleheads. This concept of investing early and often is one piece of advice that's echoed across every personal finance book, podcast, and experts. Why? Because of the magic of compound interest. Albert Einstein allegedly called the compound interest the 8th wonder of the world. Whether he actually said that or not, the sentiment still rings true. When you invest early, your money has more time to grow, not just from the returns on your initial contribution, but from the returns generated on those returns. It's exponential growth. Let's say you invest $1,000 a year, starting at age 25, and earn an average 7% annual return. By the time you're 65, you'll have around $200,000. But if you wait until 35 to start, that total drops to about $95,000. That is the cost of waiting. Over $100,000 less, even though you invested the same amount each year. So get into the habit of investing early and investing consistently. One of the easiest ways to do this is by automating your contributions. Whether to a 401k, IRA, or a brokerage account, ensure you're always participating no matter what the market is doing and how small your contribution is. The best time to plant a tree was 20 years ago. The second best time is now. The number 5 Boglehead investment philosophy. Diversify. Instead of trying to predict which individual stock or sector will outperform, the Bogleheads approach says this: diversify as much as possible by buying the whole market. Now, some people hearing this might be thinking, if I diversify across the whole market, wouldn't I just get the average market returns? Shouldn't I try to maximize my returns and not be satisfied with the average? Well, if you think you're the Bruce Lee of investing, maybe. But if you're a mortal white belt like the rest of us, embrace the average. And it's not just me saying this. This philosophy is rooted in evidence. Numbers of studies have shown that over the long term, most actively managed funds fail to outperform a simple, diversified index fund. According to a SPIVA US scorecard from the S&P Dow Jones Index, over a 15-year period, over 90% of actively managed US equity funds underperform their benchmarks. And even when some managers do outperform in the short run, there is no reliable pattern of success. Funds that beat the market one year are just as likely to lag behind the next. The Bogleheads approach is simple. Instead of chasing that elusive winning stock or fund, invest in broadly diversified index funds that hold thousands of companies across different sectors and geographies. This spreads out your risk and captures the average market return without the drag of high fees or failed predictions. Or as Jack Bogle put it, don't look for the needle in the haystack, just buy the haystack. The number 6 Bogleheads investing philosophy. Invest with simplicity. When it comes to effective investing, the truth is that you don't need 20 different funds or a complicated mix of asset classes in order to succeed. In fact, most often just 2 funds, a total stock market index fund and a total bond market index fund, can build a portfolio that's diversified, low cost, and effective. And if you want to add an international exposure, the classic 3-fund portfolio gives you that. US total stocks, international total stocks, and US total bonds. And this kind of simplicity has real benefits, not just on investment performance, but on your quality of life as well. It not only lowers costs, it simplifies tax reporting, makes rebalancing easier, and dramatically reduces the mental overhead of managing your investments. And the effectiveness of simplicity is not just some random theory. It's backed by decades of research. In fact, many of the most successful individual investors are not the ones who micromanage their portfolios. They're the ones who pick a simple, sensible plan and stick with it. There are even studies that prove portfolios of dead people perform better than most because they don't tinker with it. Actually, correction, they can't tinker with it even if they wanted to. But you get the point. Does this portfolio seem overly simplistic, even amateurish? Get over it. Over the next few decades, the overwhelming majority of all professional investors will not be able to beat it. The number 7 Bogleheads investing philosophy. This one is pretty straightforward. Use index funds when possible. Let's talk about index funds briefly for those of you who might be new to this. Jack Bogle pioneered the first retail index fund in 1976. At the time, some members of the financial industry called it the Bogle's folly because they thought the notion of buying the whole market was just ridiculous. Well, fast forward to today, index funds hold trillions of dollars in assets and it is still growing. And why is it so popular? Because when you buy a broad market index funds, you're essentially owning a piece of every publicly traded company in the United States. That is instant diversification. And you get this at extremely low cost, about 1/10 of the industry average. And here's the real beauty. If one company fails, it barely affects your portfolio. You're not betting on any single winner, you're investing in the entire economy. Yes, you're still exposed to volatility of the overall market, but you also capture all the long-term growth that the market provides over time. The Bogleheads also extend the strategy globally. Many use low-cost international index funds, like Vanguard's Total International Stock Market Index Fund, to get exposure to companies around the world. These funds include businesses from both developed and emerging markets, adding another layer of diversification. Whether it's domestic or international, the key idea is simple. Use index funds to keep costs low, diversification high, and your investing strategy straightforward. Now, before we continue, I got something special I'm excited to share with you. Have you ever wondered what your unique financial strength might be? Your money superpower? Perhaps you're naturally disciplined with spending. Or maybe you have a special knack for thinking about investments. Some of you might even have that valuable gift of patience that allows wealth to compound over time. Well, I put together what I call the Money Superpower Quiz, a quick assessment that'll help you identify your personal financial edge. After completing it, you'll not only discover which money superpower you possess, but you also get personalized strategies designed specifically to amplify that strength as you build wealth. And the best part? It's completely free. Just a small token of appreciation for tuning into my very dry and boring videos. The link is in the description below to discover your money superpower today and start putting it to work. Number 8 Bogleheads investing philosophy. Minimize cost. If there's one guarantee in the world of investing, it is this. You can't control market returns, but you can control how much you pay to participate. And these costs, they matter. A lot more than most people realize. The Bogleheads are crystal clear on this. High fees eat into your returns like termites in a wooden house. On the surface, the difference between a fund charging 0.15% expense ratio and one charging 1.5% might seem tiny. But over time, the impact of compounding makes it massive. Let's say they invest consistently for 30 years. That 1.35 difference in fees could cost you several $100,000s in retirement savings. Money that should be compounding for your benefit, not into the pockets of fund managers. In fact, according to Bogleheads, paying just 1% more in fees can reduce your retirement funds by an entire decade. That's why the Bogleheads so strongly favor low-cost index funds. While we can't control what the market will do the next 10, 20, or 30 years, we can definitely control how much we pay to participate. As Jack Bogle famously put it, in investing, you get what you don't pay for. Number 9 Bogleheads investing philosophy. Minimize taxes. According to Bogleheads, after deciding your overall investing strategy, the mix of stocks and bonds that determine your risk tolerance, the next most impactful step is tax efficiency. Why? Because every dollar that you don't lose to taxes is another dollar that stays invested and keeps compounding. Here are a few tips to minimize taxes. 1. Max out your tax advantage account. 401ks, IRAs, Roth IRAs. These accounts allow your investments to grow tax-deferred or tax-free, and that makes a huge difference over time. 2. Use investments that are inherently tax-efficient. Total market equity index funds, for example, tend to generate very little in capital gains and have modest dividend payouts, making them ideal tax-efficient investments. 3. Be strategic about tax-efficient placement. If you have bond funds, REITs, and actively managed funds that generate frequent taxable distributions, consider holding them inside a tax-advantage accounts like 401k or IRAs. The bottom line is this. The exact same portfolio can be worth hundreds of thousands more in retirement if you place assets wisely for tax efficiency. So before you worry about market returns or volatility, make sure Uncle Sam is not quietly draining all your gains because you're not considering tax efficiency. Number 10 Bogleheads investing philosophy. In the line of maintaining discipline, never try to time the market. Trying to predict the perfect moment to buy or sell is one of the biggest mistakes investors make, and one of the most costly. So the Bogleheads philosophy is clear. Market timing does not work. Don't even try it. Research has shown that typical US mutual fund investors actually perform far worse than the mutual funds they invest in because they buy after the fund has done well and then sell when it has done poorly. Additionally, studies on timing using returns data show no evidence of positive timing. Most investors earn less than the market due to 2 common timing mistakes: buying yesterday's top performers and letting their emotions lead them to try to predict the stock market. So the Bogleheads reject this roller coaster approach. Instead, they build a solid plan, stick to it, and ride out the market's ups and downs. No panic selling, no jumping in and out based on headlines, just a steady, disciplined strategy over time. As Jack Bogle wisely put it, the idea that a bell rings to signal when investors should get into or out of the stock market is simply not credible. Number 11 and final Bogleheads investing philosophy. Stay the course. It sounds simple, but for most people, it is actually the hardest principle to follow. Why? Because it so goes against our human nature. When the markets are soaring, staying the course feels easy. In the 1990s, when index funds are dominating, everyone wanted in. But in times of crisis like 2008, 2020, and even more recently in 2025, it got tough. That's when many investors would panic. Some sell everything, others freeze. But the Bogleheads know. Staying the course through volatility is essential to long-term success. And here's another reality. Stocks deliver high returns over time because they're volatile. Big gains don't come without big drops. So you have to maintain the resilience to stay the course no matter what the market is doing. Stay the course no matter what happens. Stick to your program. I said stay the course 1,000 times and I mean it every time. Thank you guys for watching and talking about the Bogleheads and Jack Bogle. If you want to learn directly from the man himself, please check out my video here where we review Jack Bogle's 10 simple rules of investment success. Until next time, all the best.